Greetings, Jonathan, Camarda. As we move into another month, and Congress tight-roped it again, giving us another 45 days till the next drama unfolds. Won't get into any granularity to spare your sanity, unless you have an Everlast bag hanging somewhere where you can maybe take out some of our frustrations on the political side. So I'll leave that at that. So as we go to markets, plenty of overhangs out there. We have the China supply reopening, shutting down, reopening, and as such. We obviously have rising energy prices, as we discussed a few weeks ago, right? I started to hear it trickle through the news, and the effect on the CPI. So what the Fed said, a lot of these Fed heads now come out of the woodworks just in time for October and Halloween to scare folks. Won't name the names on the major networks, although very interesting looking at the security out there. In one case, was very, very intriguing. And they're all talking about maybe going even higher into next year. Want to make sure we get the job done, but we're not quite sure what the effects would be and the ramifications. With that, we have the overhang again of credit, commercial and individual bankruptcies on the rise. Of course, we talked about the U.S. dollar continues its march after a slumber in the spring versus major currencies like the euro, Canadian dollar, the yen, keep going. All right. Interest rates continue to stay higher for longer. We now have unemployment, which was lower, starting to creep higher, from that standpoint, and all in confluence with home sales really starting to hit the brakes. And of course, with rates where they are, no one wants to move out of their low rate situation, and builders which were having a nice year, you can only do that for so long, right? Before you have to slow it down because there's nobody buying. So with that being said, it's not all doom and gloom out there. I'll get to that in a second. As we go in a quarter in a reverse and review, if you will, as it just ended this week. Markets were down. S&P overall the last few months down, 3% and change. All the sectors pretty much were in the red except for slight green for the communication sector. And of course, energy was up nicely after having a bad first part of the year. Year to date, of course, our technologies, discretionaries, and aforementioned consumer services have been up nicely into double digits for the year, but also took some of the bigger steps back, especially technologies and discretionaries over the last quarter. So where does that leave us now? Well, the bond market as well, which was kind of surfing, through the froth of the wave early in the year, generally on the long end of the curve, 10 years and beyond especially, basically ate a lot of sand here over the last couple of months. And you'll notice in your more conservative strategies, especially like active capital preservation, where we've taken the opposite side of long interest rates and shorter on the long term, especially 20-plus year duration of the spectrum, and thus have done pretty well doing that while keeping our fixed income exposure very minimal into really short-term type treasuries, and then, of course, the nicely yielding money market fund as well. On the equity side, as we look at the National Association of Active Individual Managers and the such, which that we look at, they actually took their exposure down moving through September. Again, very interesting there because, as we talked about last time, since 1981, market up 100% of the time after a negative August and September. And then when we tore the calendar pages off and went all the way back to the 50s, only 52, 57, and 1990, I was actually young back then and in college, did we have a negative October after a negative August and September. In fact, 57 was the only year we had a negative fourth quarter after a down August and September. And again, from a seasonal standpoint, the market is oversold, right? And we also have earnings, which revisions have been down, thus lowering that equestrian bar, easier for the proverbial horse, in other words, these companies' earnings, to exceed, thus providing a little bit of a tailwind, at least in the interim. Now, longer term, we think there may be headwinds for the markets, especially as we move into 24, but we're going to table that for now because we're covering what's really going on at this stage. Now, with that being said, generally seasonally, a lot of folks, you are pretty educated as we've talked about seasonal patterns. Usually from your November through May, the average on the, the high ends on up markets average in the 20s and only down in the mid 6s, while from May through November, right, the average ups or trends rather are generally more docile, only up in the average up in the mid 7s versus their down periods in the mid 8s, down mid 8s. So on probability, November through May generally where the bulk of the returns are made, but that isn't always the case. And we saw that just going back to even like 2017 and as such. So we don't like to paint the entire palette with just a broad brushstroke, but that's just simply that we look at, again, just understanding where seasonal movements are. Now, when we look at fixed income on the long end of the curve, especially, let's say, intermediate 10 and 20 years beyond, have really taken a beating over the last few months, and we are seeing some over-levering on institutional selling short of such areas, and that sometimes may really signal reversal coming up. Now, we're not saying that right now, but we are starting to look again, maybe plus 20 years as a reversion trade at some point, although we remain really short that area along rates. All things come to an end when that bus gets overloaded one way or another. I'll leave that at that. So as you go through quarterly results time, it has been a red quarter. Again, in some areas where we increased energy exposure and lack of fixed income exposure, some of you, again, may see some real dampening of some of those downside moves. But nonetheless, not as good a quarter certainly as Q2. I think all would agree. So where do we go from here? The market in the short term, like I said, is oversold. We talked about seasonally and historically, even pre-election years. You're looking probably, especially since Congress just gave us a 45-day IV, you might see a bounce here in the midterm. And generally, like I said, this is a stronger time of year where the markets can certainly maneuver to the upside as well. With that being said, again, a lot of headwinds to look at. We will continue to be eternally vigilant. You stay frosty. Until next time, Jonathan Camarda. Enjoy the fall if you're up north with the changing of leaves, kids buying, I know my kids buying Halloween costumes with mom. Enjoy your football. Hopefully your teams are winning, and if not, there's always next year. Till next time. That's, being from New York, they always said that for the Jets. Had to get that in there. All Jets fans out there, don't write me, write the company. We'll talk to you next time.